last question 4. How do we better manage emotions and translate to better returns? I use, this is really one that wasn't necessarily asked, but interestingly enough, Keith mentioned it on the macro show this morning. I actually put this question together last night on the train, so kind of nice that we were on the same wavelength here. And I was really proud, and it was really great that we saw the Hedgeye anxiety meter get to neutral trend a couple weeks ago. But as Keith said this morning, in an ideal world, this is where that anxiety meter should really just hover right around neutral. We really shouldn't get our emotions kind of too far into the greed side and too low into the fear side. So yeah, we need to like kind of harness that, right? Harness that neutrality in order to kind of try to better execute. Both Keith and I have sat down with 2 different doctors, Dr. Gio Valiente as well as Dr. Andrew Menaker, and they are psychologists and help people execute and operate at a very high level. So I'd really encourage you to go watch and listen to those conversations and do some due diligence for yourself, right? So you got to evaluate, who you are, what you do, how you tick, and also be okay with the fact that it's okay not to trade like Keith, but to take his mentality and how he approaches the game and take those components of what he does and put that into practice. So I've shared the links below this video, and we can so please go review those. And again, this anxiety meter, I'm not trying to preach here, or I'm certainly not chastising by kind of having it dip down towards the fear component. But I want to, I just want to reiterate that like folks have different time horizons, experience levels, they have restrictions within their portfolios. So evaluating kind of, yourself, how those work, how you can intertwine the Hedgeye products together to better execute, right, and to gain a successful kind of strategy. That's really what we're here to do. What I'm certainly here to help you do. So in quad 4 in particular, you get a lot of bear market rallies, and those are going to test the resolve. There's I included a chart there, chart 17, guys, where consecutive quad 4s with declining GDP. This is from the 2000 to 2003 kind of time frame, but you can see there's a ton of bear market rallies of anywhere from the low teens to low 40s, right, in terms of percent changes. But the trend was certainly down, and from the top left to the bottom right. And again, we're going to see, we're slide 14, guys, where we have our negative estimates for the next 3 quarters. Now, this is U.S. real GDP quarter over quarter, but we got them negative here for the next 3 quarters. So when you got negative GDP, it's going to be very challenging for companies to report, positive earnings and positive sales growth. So this is just like really important to kind of stick with the process. Conversely, this is obviously in quad 4, but in quad 2, buying the dip can be difficult as well, right? So not only keeping a strong resolve from in a bear market, that bear market rallies are to be faded. Buying the dip in a quad 2 environment can be very challenging. Understanding that those volatility components, the spikes in volatility in a quad 2 or quad 1, even a quad 3 environment where you want to buy the dip, that those spikes of volatility are episodic, non-trending, versus here in quad 4 where they are not episodic and they are trending, right? So trending to be more trending to be bullish. VIX is trending to be bullish. So try to focus on the overall process, right? Our risk manager in chief has been practicing his process for 25 plus years, and he's a heck of a steward to try to get us into the have the right components inside the portfolio. And so, lastly, I just want to kind of reiterate the fact that at a 16 volatility, that implies general price moves are about 1%. At 32 vol, it implies a 2% move. So these moves that you've seen, and guys, if you pull up slide 19, thank you very much. Like look at these moves the last 5 days. This. So I obviously don't have Friday's moves, but this would have been Thursday, yesterday 23rd, and March 22nd. There are the 2 big purple boxes on the right, and and those were over 2% moves from kind of peak to trough there. And so these are big swings. Similarly, earlier in the week, we had similar kind of big sell-offs as well. So this is very much in line with volatility kind of in the F bucket, even though, we're currently right in the chop bucket. We're kind of in the low, what are we today? So kind of in those low 20s in terms of the chop bucket. So remember, the chop bucket is 19 to 29. So, it's, you got to just kind of like be kind of, be pragmatic, be patient, understand both like the downside and upside risks, as well as the fact that this chop is very choppy, and being nimble is key. And if you can't be nimble, then staying on the sidelines is also totally cool, right? Cash is an asset allocation and 100% a choice. So kind of keeping that in mind as well is really crucial to executing successfully. And I think, if you just stick with our core principles of preserve, protect, and compound, you don't have to compound in every quad, and understanding the environment or the phase, of the market that we're in, but really having a key focus on the preserve and protect part, that can be crucial, right? But again, if your desired goal is to try to compound in regard, in every market transition or market phase, there's no better way than us to help assist in making that happen. So just want to kind of reiterate that fact, and let's work on trying to get those emotions back to neutral. Because again, it's just, you should, if we can have no feelings or minimize the feelings, or it's not really even minimizing the feelings, it's just harnessing those feelings so that you can better execute. So, whether you have to fade those feelings, or you just kind of lead into them, you're like, hey, listen, this is not an opportunity.